Okay, so where are the real opportunities hiding in the investment world today? I mean, is it still just, apps and algorithms floating out there in the cloud? Or is maybe something more grounded, taking shape?
That's that's a great question. And it's pretty much the driving force behind this deep dive.
Right.
We're looking at some really, really compelling insights from a Swiss economist, Dr. Pooyan Ghamari. We've
Right.
got excerpts here from his writing. It's called Tangible Assets and Digital Layers, the Next VC Boom.
And what's so fascinating, I think, about this analysis is the core argument. It's saying the next big wave for venture capital, the kind that really drives growth and value.
Yeah.
It's not going to be just purely digital.
No, exactly. It's poised to be this powerful, almost counterintuitive mix of physical assets and really cutting-edge digital innovation.
Like the old meeting the new, but in a very specific way.
Yeah, think of it like the enduring value of the physical world.
Mm-hmm.
Think gold, think property.
Yeah.
Meeting let's say, the efficiency and the accessibility of the digital world. So our mission here in this deep dive is to really walk you through Dr. Ghamari's argument. We'll look at the specific examples he uses, gold and real estate are the big ones, and sort of dig into the surprising details, the implications he points out.
Right. The goal being for you listening to really get why this convergence matters and what it might mean for how value is created, how it's understood going forward.
Mm-hmm.
Okay, let's unpack this then.
So the foundational idea, it's a pretty significant shift. It's not about, getting rid of physical assets or anything like that. It's more a move towards tangible assets, things with intrinsic value like gold, like real estate, and then, crucially, enhancing them.
Enhancing them how?
Using digital layers.
Yeah.
Technology.
Right. So instead of just these maybe ephemeral digital things, we're talking about using tech to amplify the potential of stuff you can actually, see and touch, stuff that's held value for ages.
Exactly that. It's like you acknowledge the enduring worth of the physical, right? But then you use technology to strip away all the old inefficiencies, the barriers that kind of limited their potential before.
Okay, let's start with gold. I mean, it's the classic timeless asset, isn't it?
Absolutely.
Thousands of years of history. It's seen as a store of value everywhere. It's physically scarce. There's this deep significance. But let's be honest, traditionally, investing in physical gold or trading it's been cumbersome.
Oh, definitely. Opaque, logistical nightmares, sometimes not really easy for, the average smaller investor to get into.
Yeah.
And that's exactly where these digital layers just completely change the game. Take tokenization, for example.
Okay.
It basically allows for fractional ownership. So you don't need to buy a whole gold bar or even a whole coin.
Yeah.
You can own a digital token that represents just a tiny slice of a much larger, securely stored pile of gold.
Which is huge for democratizing it, right?
Yeah.
Suddenly gold isn't just for institutions or the super rich.
Absolutely massive.
Yeah.
And then you layer on blockchain technology.
Mm-hmm.
This brings transparency, security to transactions that used to be complex, needed lots of middlemen. It gets rid of geographical barriers, slashes costs dramatically, and makes gold way more liquid. You can trade it globally, almost instantly.
And the source even mentions AI playing a role, machine learning.
Yeah, it does. For things like optimizing trading strategies, predicting price movements, maybe with more accuracy by crunching huge amounts of data.
Yeah.
Even streamlining the whole supply chain, from digging it up to getting it distributed.
Wow.
It adds this layer of efficiency, this intelligence. It was just, unimaginable before for such an old school asset.
So for you listening, the takeaway here is potentially easier, maybe more affordable access to gold, much more liquidity if you decide you want to sell, and just better transparency in owning it and trading it.
Right. It's the same underlying value, but made dynamic, made accessible for today's world.
Okay, so that's gold. Let's transition now. Let's look at real estate, another asset class with just undeniable intrinsic value.
Definitely. It's a cornerstone for wealth preservation.
Yeah.
Obviously generates passive income through rent. It's seen as an inflation hedge, tends to appreciate over time. But again, traditional real estate deals are famously slow,
complex.
Yeah, and frankly, pretty conservative in how they operate.
Conservative is putting it mildly sometimes. All the paperwork, escrow, legal stuff.
Exactly. But these digital layers are starting to fundamentally rewrite those rules too. Think about blockchain and smart contracts.
Okay.
They can automate things like the escrow process. They can instantly verify land titles, ownership history, streamline that whole legal and admin side of things.
Which makes it faster.
Cheaper. Much faster, yeah. Less prone to errors, less fraud risk, and significantly cheaper overall.
And tokenization pops up here again, just like with gold.
Crucially, yeah. Enabling fractional ownership in real estate is, well, it's a total game changer. It democratizes access to really high-value properties that, historically were only really available to big funds or extremely wealthy people. Yeah. The source gives some great examples, like imagine owning a tokenized share of a prime commercial building right in downtown Zurich. Or maybe a piece of a luxury villa in Dubai.
Wow, okay.
Tokenization makes that kind of granular ownership possible. And then it lets those shares be traded on secondary markets really easily. Unprecedented ease, really.
That completely redefines who can even participate in global real estate and what kind of properties they can get access to.
And it's not just about the transactions either. The digital transformation goes further. AI and big data analytics are seriously revolutionizing how real estate development and management happens.
Oh, so.
They're becoming these indispensable tools for, say, identifying market opportunities, predicting valuations with more accuracy, even optimizing urban planning decisions.
So it's less about just relying on gut feeling or knowing the local area.
Much less. AI can chew through massive amounts of diverse data demographics, economic stats, infrastructure plans, even things like satellite imagery or social media chatter.
Social media?
Yeah, sentiment analysis to identify areas with the highest growth potential, or maybe properties that are currently flying under the radar, undervalued. Predictive analytics can forecast rental yields, figure out the best ROI for renovations, recommend the optimal time to buy or sell.
It's moving from an art to a science.
Exactly. A very data-driven science.
And the source mentions the whole smart city idea fits in here.
Absolutely. Smart cities are kind of like a macro-level digital layer applied to the whole urban environment. You use IoT sensors, AI managing systems. They enhance how everything functions, the efficiency, security, just the overall livability.
Which makes properties in those cities more attractive.
Inherently more attractive, yeah. Draws more investment, potentially pushes up valuations.
Okay, so we've got gold, this ancient store of value, and real estate, this tangible wealth builder, both getting wrapped in these sophisticated digital layers.
Right, and this convergence, this combination, it creates genuinely new kinds of hybrid assets. Yeah, they combine that fundamental security, the intrinsic value of the tangible thing, with the liquidity, the transparency, the efficiency that the digital tech brings to the table.
Interesting. The source even suggests this could be like an antidote to some of the purely speculative bubbles we've seen, in markets based on assets with maybe less substance.
Yes, that's a key point, because the value is still anchored in something real, something enduring the gold, the physical building, the land itself. But the technology just makes it easier to trade, easier to manage, easier to understand.
So the next potential boom is built on substance, but supercharged by tech.
That's the argument, yeah. Built on substance, enhanced by tech.
And this must have pretty big macroeconomic implications, right? Especially with all the global instability, concerns about inflation.
Precisely. Tangible assets, gold, real estate, they've always been seen as hedges against, currency losing value or market volatility.
Right.
By digitizing them, they become more accessible, yes, but also more resilient for international investors who are looking to diversify. Maybe get away from just traditional stocks or really volatile crypto.
So you could potentially invest in tokenized real estate in another country or own a fraction of gold stored overseas much more easily now.
Relatively easily, yeah, compared to how it used to be.
Okay, this is where, for me, it gets really interesting. Because the source we have includes this exclusive FAQ section. And it dives into the practical, sometimes really surprising details that come out of this convergence. It goes beyond the concepts, gets into the weeds.
It really does. It drills down into specific questions that, investors, policymakers, even just people who are curious might have.
Like, okay, let's take real estate again. We all know rising interest rates can signal a downturn, right? But what other sort of macroeconomic indicators does the source highlight? Things that maybe aren't getting as much attention.
The analysis points to several key signals to watch. Things like a sharp, sustained decline in new housing starts or building permits. That suggests a real lack of confidence on the supply side.
Okay.
Also, a really pronounced withdrawal of foreign direct investment, FDI, specifically in real estate. That can be a major red flag for demand dropping off.
And what about household debt levels?
Crucial, yeah. Keep an eye on rising household debt-to-income ratios, DTI. That, alongside maybe rising rental vacancy rates in major cities. And, this is interesting, pay close attention to the gap. The gap between how fast median household incomes are growing versus how fast property prices are appreciating.
If prices are way outstripping earnings.
That imbalance often signals something unsustainable is happening.
Right. Speaking of global shifts, there's so much talk about de-dollarization. The BRICS nations pushing for alternative systems. How does the source think that might impact global real estate flows?
It argues these moves to rely less on the U.S. dollar could fundamentally reshape where capital actually flows. It might divert wealth, divert investment away from traditional Western real estate markets.
And
towards emerging economies, specifically within the BRICS group and maybe their allies.
So places like Dubai, Riyadh, Mumbai, maybe certain African capitals, they could see a big surge in demand.
That's the suggestion, yes. They could become increasingly preferred spots for non-dollar wealth that's looking for stable or maybe high-growth tangible assets. The analysis basically says, hey, investors, maybe look at markets benefiting from more inter-BRICS trade and investment as part of diversifying.
Let's shift gears slightly. Let's talk strategies, specifically for sophisticated, high-net-worth investors, especially when things feel uncertain. The source mentions a few key approaches they might take.
Yeah, things like distressed asset acquisition, basically buying properties from sellers who are highly motivated or maybe over-leveraged, often at a discount. But that requires really fast due diligence, quick access to capital, focusing on resilient niche properties, things that have pretty stable, non-cyclical demand, like data centers, specialized logistics facilities, maybe healthcare properties.
And structured debt investments. What's that?
Basically offering fixed income streams that are secured by real assets. That can look pretty attractive when markets feel volatile. And also adaptive reuse projects, taking underperforming assets like maybe old office buildings and converting them into something in high demand like residential units. Often you can leverage government incentives for that too.
Okay. The analysis also gets into central bank policies, but beyond just interest rates. How do things like QE, quantitative easing, and QT, quantitative tightening, plus these macroprudential measures, how do they actually influence real estate markets?
Right. So the source explains quantitative easing, QE. That's when a central bank pumps liquidity into the system, usually by buying assets. That often pushes investors towards real assets, like property, potentially driving up prices.
Inflating prices.
Potentially, yeah. And quantitative tightening, QT, is the opposite. The central bank shrinks its balance sheet, pulls liquidity out, and that tends to cool markets down.
And these macroprudential measures, they're a bit different, aren't they?
Exactly. They're more targeted regulations aimed right at the financial system itself, trying to ensure stability. Think things like loan-to-value limits at LTVs, or debt-to-income ratios, DTIs, for borrowers, or maybe requiring banks to hold more capital.
So they don't change the main interest rate?
No, but they restrict who can borrow and how much they can borrow. So they can curb excessive credit growth, rein in speculative buying. They can really influence housing affordability and market stability by stopping bubbles that are just fueled by too much leverage.
Okay, let's dive specifically into tokenized real estate. What does the source see as the biggest hurdles right now, and maybe the most exciting untapped opportunities?
Okay, challenges first. A huge one is regulatory uncertainty. It just varies so much from country to country, jurisdiction to jurisdiction. How do you treat these tokens? Standardizing how you even value these fractional assets is still kind of evolving. And, of course, cybersecurity. Huge concern with any digital platform holding value.
Makes sense. And the flip side, the opportunities.
Oh, they're potentially vast, enabling micro investments in super high value or luxury properties that were just completely off limits before to regular investors.
Right.
Facilitating peer-to-peer lending, where the loan is secured by tokenized real estate assets that opens up totally new ways to fund things.
Yeah.
And maybe really interesting down the line, making genuinely ESG-compliant investments easier.
ESG, environmental, social, governance.
Exactly. Imagine having transparent, unchangeable data streams showing a property's environmental footprint or its social impact metrics, all tied to the token.
Interesting. Now, why does the source suggest that sophisticated, high-net-worth individuals seem to be increasingly favoring tangible real estate over, say, traditional stocks right now?
Well, there are several reasons highlighted. The standard ones are there: asset-backed security, reliable income, inflation hedging. But a key point made is superior geopolitical risk diversification.
Compared to stocks.
Yeah, equities are often tied very closely to a single national economy or political climate, Real estate, if it's spread across stable, diverse international markets, can offer a better buffer against regional conflicts or political shocks.
And tax advantages play a big role, too.
According to this analysis, absolutely. Things like depreciation deductions you can claim. In some places, mechanisms like 1031 exchanges that let you defer taxes when you reinvest. Favorable capital gains treatment for primary homes.
Things you don't usually get with stocks.
Not to the same extent, usually. Plus, you have the potential for direct control over the physical asset, and the strategic use of leverage is often very appealing to that investor group.
Which emerging global cities does the analysis pinpoint as being really well positioned to become major future real estate hubs in this kind of new landscape?
Dubai, Singapore, Riyadh, and Zurich are the ones specifically called out.
Okay, what makes them special in this context?
The source points to a mix of factors.
Mm-hmm.
Things like strong pro-business policies, political and economic stability, which is huge, massive infrastructure projects happening, growing expat populations fueling demand, specific initiatives like Saudi Arabia's Vision 2030, which is driving enormous real estate development, and Zurich's role as this stable, discrete financial hub that attracts high net worth individuals looking for wealth preservation.
Let's circle back to AI for a second. How is it really transforming real estate decisions, going beyond just spotting trends or gathering data?
It's moving into predictive and even prescriptive capabilities.
Prescriptive?
Yeah, so predictive modeling uses really complex algorithms on massive data sets. We mentioned satellite imagery, social media sentiment before that forecast prices, forecast demand with remarkable accuracy. It can even flag potential risks almost in real time.
And prescriptive means it tells you what to do.
Kind of. It recommends actions. AI might suggest the absolute optimal timing for buying or selling a property. It could recommend the most profitable renovation strategy based on super granular local market data, or even identify potentially distressed assets before anyone else knows about them.
Wow.
And for big portfolio managers, AI helps optimize diversification across different markets, hedging against localized shocks, maybe identifying hidden arbitrage opportunities globally.
What about some of the overlooked regulatory risks, especially for international real estate investors in this changing environment?
The analysis flags a few key ones. Evolving ownership laws. Some countries might bring in stricter limits on non-resident buyers or slap higher transaction taxes on foreigners. That's a real risk to watch.
Oh, okay.
Also, increasing sustainability and green building mandates. These are becoming critical requirements in many places, and they can really impact renovation costs or even property values if you don't meet them.
And with all the digital layers we've talked about.
Exactly. The fragmented nature of crypto and blockchain regulations across different countries is a major headache, especially how tokenized assets get classified. Are they securities? Are they property? It varies. And then you have the whole anti-money laundering, AML, and know your customer KYC compliance nightmare across different jurisdictions. Plus, there's this potential risk of tech sovereignty, where nations basically try to control the digital infrastructure and data flows within their own borders.
Yeah.
That could really complicate things for seamless global tokenized platforms.
Right. Okay, finally, geopolitical instability. How does that actually play into real estate prices? And does the source suggest how investors might navigate or maybe even leverage that volatility?
Yeah, it's interesting. Geopolitical instability often triggers a significant flight of capital out of volatile regions. That can actually create opportunities for buying distressed assets if you're willing to take on that risk and have a long-term view for recovery.
And the flip side?
The flip side is it drives a flight to safety. Capital rushes into markets that are seen as stable havens, and that can lead to rapid price appreciation there.
So this raises a big question. How do you leverage that?
The source suggests investors need basically foresight and agility. By actively monitoring global flashpoints, understanding where capital is likely to move, they can potentially position themselves, either to invest in markets that are temporarily down due to instability, assuming they believe in a long-term recovery, or in markets poised to benefit from that inflow of safety-seeking money.
And underpinning this whole transformation, the analysis really emphasizes the critical need for policymakers, for governments to step up and create robust, clear regulatory frameworks.
Absolutely essential. Clear guidelines for how tokenized assets work, for cross-border transactions, data privacy, digital security. That's fundamental for building trust and letting this whole market reach its potential.
The countries that get ahead on adapting regulations are likely the ones that will attract the most capital and innovation in this space.
That seems very likely, yes.
So, okay, as we wrap up this deep dive into Dr. Ghamari's work, the core takeaway seems pretty clear. The future of value the future of investment. It isn't just in the digital ether, nor is it just in the physical world alone.
No, it's in this powerful, evolving fusion, this mix of enduring, tangible assets gold, real estate being fundamentally underpinned, enhanced, made dynamic by these sophisticated digital layers.
It's really about unlocking, unprecedented accessibility, liquidity, transparency, resilience in these traditional assets, making them more versatile, more dynamic stores of value for what's clearly a rapidly changing global economy.
Exactly.
So, considering all these insights we've just explored, I mean, from the idea you could own a tiny fraction of a building anywhere in the world through tokenization, to AI predicting subtle market shifts, to understanding how geopolitical events directly ripple into real estate prices, how might your personal approach, your way of understanding and maybe building value, need to adapt in this converging physical and digital world? What stands out most to you?